So, folks, it's 6:01. I'm David Edwards, president of Heron Wealth in New York City. I have my friend and associate, Buff Parham of Parham Associates, down in South Carolina, down by the beach. Tonight's webinar is going to be about how we use our financial planning tools to show our clients the future. And the reason why we do that is because that process converts fear into joy. And I'm going to put Buff into silent mode for a while. I'm going to run through our basic demonstration of our planning platform. That should take, I'm going to say, 10 to 15 minutes. I'm going to try and keep it on the short side. We got quite a few questions in the last couple of days on a broad range of topics. So when we get to the Q&A, I'll bring Buff back on board, and he will ask those questions, and I will answer them as best I can. And our plan is to wrap up by 6:30. So Buff, I'm going to put you into attendee mode, and I will begin. So when we're talking to our prospects, like to show them our demo family, Frank and Joanna Miller. And this is a quick view of their dashboard. Their net worth is about 1.8 million. They have some investments. They're in their early 50s. They've got one child still in college. They're thinking about their future, their retirement, their second home. And the number one question they have is, do they have enough money to enjoy their life? So we're able to capture everything about them, continuously updated, the assets that we're managing for them, assets that we're not managing, which might include a 529 plan for their child, Frank's 401k at work, Joanna works for a hospital, her 403b, and some life insurance as well. And our clients have the ability at any time to get a live update on their personal balance sheet, which might look like this, for example. And so broken down by categories, we can see that they have some cash on hand, $25,000, their taxable investments, life insurance policy, their retirement plans, Roth IRA, business interest that Frank has. He values it at $30,000. They have their personal home for $850 and a vacation home for $350, and then also some jewelry and cars and whatnot. So in aggregate, their wealth is 1.8 million. That's minus their American Express card and minus their mortgage. And the question they have for us is, can they afford to retire? So what we do before we answer that question is we capture all of their income and spending, and we can show them over the next 5 years where the money goes. So here, for example, is their 5-year cash flow report. And we see Frank's salary, $300,000 a year, Joanna's salary, $50,000 a year. They're spending about $12,000 a month. Their mortgage costs $44,000 a year. But look over here, 319. This is the balloon mortgage. They've got a big cash flow coming up in 5 years. Still one child in college, $50,000 a year, life insurance premiums, taxes, and how much money they save into their 401ks. So right now they're drawing down about $35,000 a year, mostly to cover Lucas's expense in college. That's coming out of 529 plans. And then we've got this big concern over here. And by the way, it's not just the next 5 years. We can look at the 5 years after that and see more what's going on in the future. After they get past that balloon payment, they're cash flow negative, and then salaries stop when they're 65 and 64. And so that number there, $137,000, is how much money they need to draw out of their investments to support their lifestyle in retirement. And we can actually see what the withdrawal rate on that portfolio is. Whoa, it's high. It would be 8% in the first year. And we know that a sustainable draw rate on a portfolio is between 4 and 5%. So if you draw at 8%, what happens? Well, we can show them. So right now, if they made no changes in their lives at all, they would retire here at 64, 65. That's the little retirement button down here. And then they'd be spending money. And there's a problem. They would run out of money by the time they're in their early 80s. So that's the bad news. The good news is we have a 25-year head start to figure out alternatives. So, for example, we can imagine anything that they can imagine, we can model as a technique. We can add more income. We can give money away to charity. We can buy a car. We can change their living expenses. We can change their retirement ages. Anything they can imagine, we can model. And this is how slick it is. I set up a model already where we sell a vacation home and drop the vacation house expenses, and problem solved. And that kind of makes sense. We throw an extra $350,000 into their investments here, and then we don't have those expenses, and the problem goes away. But maybe they don't want to sell a vacation house. Maybe they want to try something else. Maybe they want to retire 5 years later. Yeah. Again, problem pretty much solved. Uh, if they make it to 100, they might have some problems. Um, but then the husband might say, "Hey, David, you know how I told you that I value my ownership in the business at $30,000?" And I would say, "Yeah." I said, "Well, actually, we got an offer to sell the business recently, and my share of that would be $1 million in a couple years." Oh, well, that's the big cash flow right there from the sale of the business. And again, problem solved. So the value of this process is that while I'm on a Zoom call, while I'm sitting in my office, my clients can pepper me with questions and can very quickly see what the alternatives are. And what we like to say is that from good data comes good decisions. So this family, if they were actually able to achieve selling this house, this business for $1 million, would be able to keep both of their properties, and that'd be very good news. And we can look at a couple other models as well. For example, yeah, the expected portfolio is those green bars and blue bars over the next 25 years, but this actually gives a range of outcomes. The solid blue line here is the expected return. The darker blue band is if markets do really badly, and the light blue band is if markets do really well. So overall, because there's some uncertainty out here at age 97, we can see that the probability of the success of the plan is only 41%. All right, that's good to know. We could go back and change the retirement age. And we see that, oh, now the probability of success is 99%. Now, how realistic are these numbers? Is it exactly 41%? Is it exactly 99%? No, this is just a red light, yellow light, green light indicator. If we're at 80%, that's kind of a yellow light condition. If we're at 50%, that's a red light condition. If we're at a 90 or above, that's a green light condition. And all of our work with our clients is to get us to 80% or better probability of success. So that is what I wanted to cover in just these few minutes. Oh, I'll show you one more report. Cash flow. People want to know, where's the money coming from? Well, this report here shows that at least through retirement age, most of their income is coming from salary and bonuses. There is that big green spike there when they sell the business. Social Security kicks in eventually. Then they start drawing money on their portfolios, but finally they're required to take money out of their IRAs once they turn 72. And then this green spike here at the end is when, unfortunately, Frank dies, and an insurance policy generates some cash flow, and then the wife dies the following year. Joanna dies the following year. So people just want to know at age 57, are they going to be okay at age 96? And using these tools and using our experience, we can make that happen. So let me just make one more comment. We use these tools in all of our annual meetings. And if we have not used it with you recently, don't worry, we're getting to you. It's been a long 12 months, but we're working our way through our entire client base. And then the other thing that people should know is that it's not a once a year situation. Pretty much, if a client has a question, as in I just changed jobs, I just inherited money, something's going on, they can tell us the few things have changed. We can quickly update their plan, and then go right to answers. So it's an incredibly powerful tool. In the olden times, like 10 years ago, we used to do this with Excel spreadsheets and PDFs, and it was slow and tedious, and we hated the process, and the clients hated the process. But now it's easy and fun, and makes it a joyful experience. So let me end the screen share here. Actually, you know what? I'll leave the screen share up for a minute. Buff had a couple questions of his own. Let me bring him in. And Buff, you're on mute for that. Now you're unmuted. Perfect. Let's jump to questions.
David, I think you answered my first question, but I'll ask it anyway. How often do you share this type of analysis with a given client?
Yeah. So for sure, doing our annual review, but some clients want to see a semi-annual review. Some want to see a quarterly review. The most important time to use this tool is that when something important has changed in your life, a transitional life event, could be an inheritance, could be changing jobs, could be having a child or a grandchild, could be selling some real estate, could be buying some real estate. Whenever you need financial information, that's when our clients loop us in and we talk it through and we show them the answers, and then they go away satisfied that they've made the best possible decision.
Now, if I happen to have some assets under management elsewhere, can we incorporate those into this modeling tool?
Yep, you absolutely can. With Frank and Joanna, the way we modeled it is that here are assets that we're managing directly, and here are assets that we're not managing directly, but we've incorporated them into our plan.
And how do I know what the underlying macro assumptions are? For example, rate of inflation, interest rates, stock indices, et cetera.
Yeah, super good question. So the investment screen here lets us estimate what, this asset class screen tells us what's inside the portfolio. Now, because this is a demo model, it's not very helpful. But if I pulled up a more typical model of one of our clients, which would be over here, we can see that this portfolio is comprised of about 80% equities, and then the rest is bonds and cash. And then there are different subcategories here for international, small growth, large value, investment grade bonds, etc. And this platform is connected to Ibidson, which is a subsidiary of Morningstar, which is kind of the gold standard for research. And Ibidson gives us a 20-year forecast of these different asset classes. Large cap growth might be 7%, large cap might be 8%, large cap value might be 7%, emerging markets might be 10%. Bonds, corporate bonds might be 4%. Well, how reliable can a 20-year forecast be, right? Simply extrapolating what happened over the last 20 years is not the best possible strategy, but we got to use something. So what we do is we take the Ibidson estimates, subtract 2% from the equity models and 1% from the bond models, and then apply those values across all these asset classes. And what comes out of that is a blended rate of 7.45%. That's pretty good, right? Frankly, anything over 6.5% in the current environment is pretty good. But that's why we have a speed limit of 4 to 5% on the draw rate. There's going to be a couple crappy years in there. And if you're drawing at an 8% draw rate and you have 2 or 3 bad years in a row, you don't have enough money left over on the other side. So we keep an eye on the projected growth rate. We keep an eye on the draw rate. We keep an eye on how the portfolio is doing against its benchmarks. We're flying a 747. We have a lot of indicators to let us know that we're heading in the right direction. And also, if we're heading in the wrong direction, we have ways of being alerted. And this question may come up. Yes, that's a good place to stop.
Well, is it feasible to model using only liquid assets, leaving out real estate, for example?
Yeah. So this particular estimate here is all about liquid assets. And when we were looking at that plan earlier on, the bar chart was actually the value of the liquid assets only. And then there's some other reports we have that show liquid assets plus real estate. And that's important because you might have a $2 million house, but you can't break off a piece of siding and go to the 7-Eleven with it. You eat the cash flow from liquid assets, not from real estate or cars or jewelry.
And here's one of your favorite topics. Do you recognize cryptocurrencies as a valid asset class for this type of modeling?
So interestingly enough, a couple of our clients do have Bitcoin portfolios that they very cautiously tell us about. And I just say, fine. You have a lottery ticket in your glove compartment. Maybe right now Bitcoin is $60,000 a unit. It was $3,000 a unit, 2 years ago. We could actually create a fact and call it your Bitcoin account. You'd have to tell us every couple of days, what's the value of it because it goes up or down. And we'd assign it a 0% growth rate because it's just, I can't tell if it's going to go up or down. We do have the ability to capture it in a client's portfolio, and hopefully it works out for them.
The Heron Wealth Bitcoin hotline. I understand.
Heron coins. I'm gonna start producing Heron coins.
Here's a question from one of your people. A good friend, a retired banker, told me on Friday that we are heading for a crash. Part of our rationale is that we, I think the USA, are spending too much money.
Yeah.
Is a crash likely? A correction in the market seems possible to me.
Yeah. There's always the potential for a crash. It's currently April 2021. Between February 2020 and May of that year, the market fell 35%. It fell 20% in the fourth quarter of 2018. It fell 55% between 2008 and 2009. So the potential for the crash is always there. And I like to say it's like the potential for running into a storm when you're driving a cruise ship is also there. And so what we do as our clients, when our clients are younger, they can afford lots of risk. They have aggressive 100% stock portfolios. As they get into their 50s, 60s, and 70s, you get them onto what we call the glide path to retirement, where we systematically reduce their equities and increase their bonds to the point where when they actually are retired, they have a year of cash in cash, a year of cash flow in cash, another 4 years of cash flow in bonds, and then the rest is in equities. And what we're doing right now, since equities have done extremely well, is we're rebalancing the portfolios that are furthest out of tolerance, selling some equities, buying some bonds, and then using those bonds to refresh the cash as people draw it down. So there's nothing magical about what we're doing. Good advisors have done this for 50 years. You can't have a 0% equity exposure because that's the part of the portfolio that keeps growing, right? Bonds, 3% right now, 3.5%, that's barely ahead of inflation. Cash, 3.3%, 0.5%, that's behind inflation. Getting the right asset allocation, getting the right mix, setting up the right draws, that is the skill that we've been practicing for 25 years.
In a similar vein, someone wrote in to say, stocks keep reaching new highs. As everyone else, I'm afraid of a crash. Should I lighten up on my equities now to avoid the inevitable crash?
Yeah.
And how will the short-term economy be influenced as the pandemic is coming under more control? People are getting vaccinated, people are returning to the work office. Does this affect or change anything we should be doing right now to take advantage of these short-term or long-term opportunities?
Okay, so let me answer the first question. Give me the first question again. Just.
They were asking specifically if they should lighten up on
Right.
equities to avoid the
So
inevitable
we're doing
crash.
that automatically for our clients anyway.
Yeah.
Is there a need to rush out of equities right now? We try and evaluate the stock market in terms of red light, yellow light, green light. And right now we've got a green light, yellow light outlook on the market. The reason why we have a green outlook on the market is because the first thing the Biden administration did was dump $1.7 trillion of extra cash into the economy, which is currently about $19 trillion.
Mhm.
And they're also trying to get an infrastructure package through of another $2 trillion. And so when you dump effectively 10% of US GDP into the economy, it's going to definitely juice things. It's going to get people back to work. They'll start buying stuff again. Companies will have more revenues. They'll have more earnings, right? But the yellow warning on that is that investors have already anticipated the benefits of all that spending. So the market is a bit higher than it should be. It's up about 7% so far this year, and it was up, I think, 17% last year. And when you go, let me understand this. We had a horrible pandemic. 600,000 Americans have died,
Yeah.
and the stock market is all the way up here. Well, you know what? The pandemic is like the neutron bomb. It kills people, but it leaves companies standing, and they're making money. Lead me into that second question again.
They were asking specifically in terms of any opportunities based on the return to the office.
Mm-hmm. So there's nothing particularly special. You know, a year ago, everyone said we should buy Peloton, we should buy Zoom, we should buy things that let you work at home. And we didn't
Yeah.
overreact to that because, you know, it'll pop for a while and then it will fall back again. And so now that people are actually going back to offices, we're reopening our office October 1st. My whole team's been vaccinated, and we've already had people coming to the office, you know, once a week just because they're sick of their apartments. So we're not. So you know, potentially you could go crazy and try and find something that will vastly benefit. But you know what? The companies that are already benefiting from the pandemic and will be going well going forward, we're doing fine before. So J.P. Morgan, Johnson and Johnson, Amazon, Apple, those are all good companies. And then we get further down into the mid caps and small caps, and there's plenty of good companies. So it's kind of like when you're sailing, the skipper that jerks the rudder back and forth and tries to chase every wind shift, they end up at the back of the fleet.
Yeah.
And the skipper that has a pretty good plan and a pretty good strategy and a pretty steady hand on the wheel, they get to the turning mark first. And I'm a sailor. I like to win races, and I do it
Steady
by
as she
a
goes.
simple strategy that I know works.
Two-part, kind of a macro two-parter here. First of all, what is your take on Wall Street versus Main Street?
Mhm.
And do you see a real uptick in the economy and sustained employment while the market continues to grow? Part two, a number of countries are experiencing economic downturns because of the pandemic. Example, Brazil, India, Italy, France. Do you see them rebounding this year, and what would the impact be on investment opportunities?
Yeah. So you know what? I'm going to ask going forward. Ask me one question at a time because I'm
Okay.
sorry to keep track. So give me
All right.
the lead into that first question again.
What's your take on Wall Street versus Main Street?
Okay,
Do you
let's
see a
hold right
real
there.
uptick in the economy
Yeah.
and sustained employment while the market continues to grow?
Yeah. So you know, don't want to get into a long philosophical conversation, but the rich got richer in this pandemic, and
Mhm.
that creates some real stress in our political system. And wow, why do people try to storm the Capitol? You know, January 6th, they were mad about their economic situation mostly. So we'll see what happens. The Biden tax plan is very progressive. It wants to slash the estate tax exemption from 11 million back to 3.5 million. It wants to raise the capital gains rate up to the income rate for high income earners. It wants to restore the state and local tax deductions, which actually would be good news for California and New York. But it right now is still a blueprint. And 50 senators have to sign off on that plan. And I already know 2 that won't. So, you know, we'll see. Roll into the second question there.
A number of countries are experiencing economic downturns because of the pandemic.
Right. So
Brazil,
this is
India, et cetera.
yeah. So the United States, amazingly, has done a
Mhm.
pretty good job of getting our population vaccinated. Something like half of the population has had the first vaccine so far, and then 25% of the has had the second vaccine. We've got a new problem now. There's a lot of vaccine resistance from anti-vaxxers and Republicans, and until we get to 70%, it's just going to be flare up after flare up after flare up, and you know, people just have to expect that. Other countries don't have vaccines yet at all. We developed them, you know, here in the U.S. and we didn't share with anybody. Maybe later. So if you go to India, you go to South America, they don't have vaccines yet, and they do have a surge in cases, and they have a surge in deaths. They don't have enough hospitals. So it will hold them back. Even Europe is backsliding right now. Spain, Germany, Italy, France, all sliding backwards, and going to have a tough summer as a result. So maybe the U.S. emerges first with a. Oh, actually, China is actually now way ahead. They aggressively dealt with the virus a year ago, and now their GDP was up 18%. That's an incredible number. So yeah, so it will take a while for the rest of the world to catch up. We always have a certain amount of exposure to developed markets, Europe, Asia, Europe, Australia, Japan, and also to emerging markets, China, Russia, South America, Africa, and we're seeing some pop there. It'll take a while to catch up.
Could you spend a few minutes on the wisdom of maybe doing a Roth conversion this year, assuming taxes will increase next year?
Right. So the best. So when you convert your IRA to a Roth IRA, you have to pay tax on the value now. So let's say you converted $10,000 and your tax bracket is 39% combined federal and state. You'd have to pay $3,900 out of pocket to make that conversion. But the fear is that, well, next year, if let's say the combined bracket is 50%, I'm just picking up a number, I'd have to pay $5,000. In general, the best time to do a Roth conversion is when you're not actually working.
Right.
I have some clients that are artists and authors, and they have highly variable income flows. Some years they have a lot of money coming in, other years no money. So in the years when they had no money coming in, those were the years that we did the Roth conversion. If you're a high income person today, I'd be hard pressed to recommend converting your old IRAs. But if you wanted to, as you put your $6,000 or $7,000 into your IRA this year, put it into the Roth, forego the $3,000 tax break you get this year, but you'll have a tax-free portfolio when you retire. So that's how I would handle that.
We're getting close. You want to go to the big question to wrap things up? You want to keep on going?
Yeah, let's do 2 more questions.
All right. This one is kind of in the same category. Should we take action now to avoid the Biden tax increases later?
And the answer is, let's wait until we know what the Biden tax increases actually are. First off, they're not going to be retroactive. That's just totally unfair.
Yeah.
The bigger issue is that taxes is the topic that makes people's blood pressure just burst. And I think it's because if you decide to spend $50,000 on a new car, well, that's your decision. But if the taxes go up and you owe an extra $50,000, that means that the government is taking my money, ignoring all the services we get from the government, like roads and hospitals and vaccines and whatever. So people tend to panic and overreact and do things to avoid taxes that cause bigger problems with their portfolio. For example, let's say capital gains goes up to 39%. You still don't have to realize capital gains until much later, right? Just take your time. Or yeah. So let's wait until we know what the actual plan is, and then we can figure out what changes we need to make after that.
Someone wrote in to say, I consider myself to be a sophisticated investor. I earn a lot and I save a lot. Why would I need a financial planner and not just a great money manager or stock picker?
Yeah, good question. Originally, 25 years ago, all I was a stock picker. But here's the thing. People don't care about investment performance. They care about outcomes. Like if I got 10% a year on my investments, but didn't get the second home that I wanted, well, that would be an unhappy outcome. Versus if I got 6% a year, but I did get the house that I wanted, well, then, you were successful. The reason why I evolved from an investment manager into a wealth advisor is because I realized that the clients really care about the outcomes, number one. Number two, by the time you're 50 or 55 years old and have a good career and some assets and some investments, whatever, you have 10,000 choices. And the ability to pick out the best 10 choices through trial and error, there isn't enough time in the rest of your life.
Yeah.
So what wealth advisors do is just guide you to the 10 choices that matter and help you pick the best ones. That's all. We're just a facilitator. And it's the same reason why you hire another professional, a trust and estate attorney. It's the same reason why you hire an accountant. It's the same reason why you hire a car mechanic. Expertise is very important and a huge time saver. So it doesn't matter how smart you are. It doesn't matter what your degrees are. It doesn't matter what your experience is. Everybody could use some good advice.
Do we have time for one or two?
Let's take one final question.
All right. I've always loved the idea of owning a second home, but hated the idea of letting it sit empty for 10 months out of the year. With the rise of remote working, I can finally see myself actually using it and being able to spend more time outside the city. Can your software help me determine if I can afford the second home? And does it make sense to buy a second home as part of my overall investment strategy, protecting me from inflation, et cetera?
Yeah. So first answer, yes, we absolutely can model buying a second home. It is literally as straightforward as going into that modeling tool that we were looking at before. And we can punch in the purchase price, we can punch in the down payment, 15-year mortgage, 30-year mortgage, balloon mortgage. We can also punch in expenses and taxes, and we can show you the effect on your wealth if you buy that second home. We also counsel people to not look at that second home as an investment. People have a fantasy that they can buy a second home and rent it out on Airbnb for part of the year and cover all the expenses, and it'll be a zero cost thing. And in actual reality, that hardly ever works because expertise matters. And unless you're a professional Airbnb host, you're going to have damage, you're going to have costs, whatever. All kinds of hidden things are going to chip away at your cash flow until pretty much it's a negative thing.
I can testify that Airbnb is break even at best.
Yeah. The reason to buy a second home is because you want it.
Right.
And it's something that matters to you. And I had a very joyful conversation with another family. I'm going to end with this story. They've been clients of mine for a long time. They've done well. Their portfolio is well into seven figures at this point, several millions. And they inherited a family home in the Saranac region of Adirondacks. And they wanted to know if they should spend $300,000 to renovate it. And so we tickled the keys, and I said, yeah, you can definitely renovate that house for $300,000. But let me ask you a question. When was that house built? The 1930s. What's the condition of it? Oh, pretty awful. I said, does it have a proper utility room? Does it have a proper basement? Is it can you use it in the wintertime? No, no, and no. I said, well, what would happen if you didn't spend $300,000, you spent $600,000, demolished that house and built the house of your dreams in the exact same footprint? What do you think of that idea? And they go, could we afford that? I go, let's find out. Click, 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 click. Yes, you can. So armed with that information, they went out and hired an architect, and they're going to spend a year or two drawing up blueprints. But because they had good data, that gave them good information, they can now move forward confidently and build that dream house. So that's the joyful part of my job. I'm going to go visit that house when it's done. It's going to be great. So Buff, here we are. It's 6:34. That's a pretty good.
Yes, indeed.
Pretty good 30 minutes. Do you got any fun plans coming up once we get into the really nice weather? Yeah, in South Carolina, can you go to restaurants now?
Yeah, everything's open. Weather's good, but a lot of time at the beach and a little bit of time on the golf course when time permits.
That sounds very nice. I am looking forward to a little bit of biking and a little bit of sailing this summer.
There you go.
All right. Good night, everybody. Have a pleasant evening.
Bye-bye.
Bye-bye.